Picture this scenario. You're 25. You just landed your first real job, the one with the salary and the benefits. You get a piece of mail that feels like a rite of passage, a shiny credit card offer with a $5,000 limit. You're responsible, so you use it wisely. You book a flight to see your college friends, $1,200 on a single swipe. You tell yourself, I'll pay this off over a few months, no big deal. The first statement arrives. You see the total balance, your stomach drops a little, and then your eyes dart to the bottom left corner. Minimum payment due, $35. A wave of relief washes over you. $35, that's nothing. That's less than a night out. You feel clever, even responsible. You set up auto pay for the minimum and you forget about it. Your life moves on. Your car needs new brakes. Your friend's wedding comes up. You need a new laptop for work. The balance quietly climbs to $3,000. Savior, but you're never late. The auto pay is working. You're handling it. But what if I told you that auto pay for the minimum isn't a sign of responsibility, it's a financial trapdoor? But what if I told you that credit card companies engineered that minimum payment number for one reason, to keep you in debt for decades, not years? But what if I told you that every single purchase you make on that card, your groceries, your gas, that coffee, is guaranteed to cost you at least double its price tag if you follow their minimum payment plan? And this isn't just debt. This is a mathematical lie, printed on your statement every single month. My name is Bobby, and I spend way too much time thinking about the hidden math of everyday finance. If you're someone who sees that minimum payment and feels that sigh of relief, or if you've ever looked at a growing balance and thought, at least I'm making my payments, or if you've ever wondered why getting out of credit card debt feels like running in quicksand, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't talking about budgeting or cutting back on lattes. We are talking about a calculated, deliberate deception. We're talking about the credit card math lie.
Here's the thing about credit card debt. Conventional wisdom tells us that making the minimum payment is the responsible thing to do. They tell you it protects your credit score, it keeps the banks happy, and it's what good, reliable people do.
But that advice ignores a fundamental, brutal truth about how the math actually works. The minimum payment is the most profitable customer behavior for the credit card industry, period. And to understand why they want you to do it, we need to talk about a powerful psychological phenomenon first documented decades ago. Let's go back to 1978. Researchers David Green and Elizabeth Winters published a paper in the Journal of Consumer Policy that cracked open how we interact with debt. They presented people with different payment options for a hypothetical loan. They found something startling. When presented with a low, seemingly manageable minimum payment, the overwhelming majority of people, over 78%, anchored to that number. And so they chose it, even when they could afford to pay more. They cited cash flow management, but they admitted they never calculated the total interest. Fast forward to the early 2000s, Dr. Drazen Prelec at MIT ran studies showing that the mere presence of a minimum payment on a statement doesn't act as a warning, it acts as a recommendation, a suggestion from the lender. People perceived their debt as less severe, less dangerous, when the minimum was small even if the interest rate was sky high. Now, bring this to today. The Consumer Financial Protection Bureau, in a 2016 report, found that among the millions of Americans carrying credit card balances month to month, the median payment made was only slightly above the minimum, often just $10 or $15 more. This region, across decades, is unanimous. The minimum payment is a psychological anchor. It exploits our natural tendency to seek the path of least immediate pain. It creates a powerful illusion of control while quietly maximizing the long-term cost. This isn't an accident, it's a profit model. Now you might be thinking, okay, Bobby, that's a nice story about old studies, but how does that apply to my actual life in 2025? Well, look around you. This dynamic is everywhere. Let's make it painfully concrete. You buy a new flat-screen TV, it's $749.99. You put it on a card with a 24.99% APR, which is standard these days. Your first minimum payment is about $25. You think $25 a month for a TV? Behavior that's like skipping one takeout meal. Easy. So you set it and forget it. But you're not just paying $25 for the TV, you are signing up for a 42-month financial relationship with that television. Every single month, $15 to $20 of your payment goes purely to interest, not to paying down that $750. By the time you finally make that last tiny payment, you will have paid $1,043.17 for that TV. The interest alone cost you a new pair of high-end headphones. Take a bigger example, a $3,000 emergency room visit. The minimum payments start around $75. It feels manageable. But at 24.90% APR, paying the minimum turns that $3,000 medical bill into a 14-year journey. You will pay an extra $3,211.50 in interest, over $6,200. Think about that. Your $60 weekly groceries cost $124.80. Your $45 tank of gas costs $93.60. Your $8 streaming subscription costs $16.64. This is what we call the double dollar guarantee. If you only pay the minimum, the math is rigged to ensure everything you buy ultimately costs you at least twice its sticker price. Let's perform a brutal audit of this guarantee. Let's call this person Alex. Alex has a very average credit card balance of $5,000 at a 2014 APR. The minimum payment is 2% of the balance or $25, whichever is higher. Alex is a responsible minimum payer, so the starting number is $5,000. That's the debt. That's what Alex sees. First, there's the sticker price mirage. Alex thinks the cost is $5,000. It's not. The true cost is principal plus interest. If Alex pays only the minimum, which starts at $100 and decreases slowly, we have to run the numbers. Sure, the running total is $5,000 plus a question mark. But that's the easy math. We all know interest exists. Now we have to add the time tax. The minimum payment is designed to stretch repayment over the maximum possible time. So how long does it take Alex to pay off that $5,000? We calculate it month by month. The minimum creeps down, as the balance does, but the interest remains a fixed hungry percentage. The timeline to a zero balance, 31 years and 5 months. Alex will be paying this off from age 30 until past retirement. The total just for interest paid over that time is $12,847.19. But we're not done. Then there's the compounding cement. In the early years, over 80% of Alex's payment goes to interest, not principal. It's like trying to fill a bathtub with the drain wide open. Here it gets worse. Then there's the darkest category, the opportunity cost, black hole. This is psychological, but we can convert it to dollars. Every dollar Alex sends to interest over 31 years is a dollar not invested. Instead of sending that average payment of about $67 a month to a credit card company, Alex invested it in a basic S&P 500 index fund, averaging a conservative 7% return over that same period. The future value of that money, the wealth that was never created, is $92,412. So let's add it up. The $5,000 of spending required $17,847 in cash, and it destroyed $98,412 in potential future wealth. That $5,000 of debt just cost Alex $116,259.19. That's not a typo. $5,000 actually became $116,000. You didn't borrow $5,000. You mortgaged a six-figure chunk of your future. Think about that for a second. And we haven't even touched on how widespread this is. According to the Federal Reserve's 2023 report, 55% of credit card holders carry a balance month-to-month accruing interest. A 22T report from the Consumer Financial Protection Bureau found the average APR on interest accruing cards hit 22.8%, a historic high. Wallet analysis in 2024 estimated the average household carrying credit card debt will pay over $1,380 in interest this year alone. Business model isn't really about swipe fees. It's an interest harvesting machine, and the minimum payment is its most efficient combine. And before you say, "But Bobby, I always pay more than the minimum when I can," the data shows that's the exception. For most revolving accounts, payment spikes are followed by a return to the minimum. The system is designed to make the minimum the habit. That $1,380 in average annual interest, that's the equivalent of making a car payment to a bank for nothing. This is where it gets really interesting. When you pay the minimum, you barely scratch the principal, but the high interest on that still large balance forces you to allocate a huge chunk of your future cash flow just to service the interest. And that drained cash flow makes you more likely to reach for the card again for the next unexpected expense, which makes the balance in the trap even worse. It's like being on a treadmill that's programmed to gradually incline. The minimum payment is the comfortable speed setting. It doesn't feel hard at first, so you don't jump off. Over months and years, the incline gets so steep you're sprinting just to stay in the same place, exhausted and getting nowhere. And here's what really gets me. Credit card industry relies on this exact cycle. They profit on you anchoring to that minimum number. They depend on you never sitting down to do the full terrifying math. Behavior that budget for your life happens moment that pushes the balance up again. When you start paying aggressively, when you attack the principal, you become a bad customer for them, but a great CFO for your own life. The industry wants you focused on the monthly minimum because that hides the lifetime total. They want you thinking about cash flow, not net worth. This isn't just bad psychology or bad math. It's predatory. This is designed. This is a scam. Now I can hear the objections already. Bobby, I have to pay the minimum. It's literally all I can afford right now. And look, I get it. That seems completely reasonable and real. Survival comes first, but that feeling that it's all I can afford is the trap talking. The goal isn't to shame you for paying the minimum today. The goal is to make you violently aware that it is a financial state of emergency, not a plan. If that's truly all you can afford, then the mission, the only mission, is to find $20, $50, anything to throw at the principal above the minimum to break the cycle's math. You might also be thinking, won't paying more hurt my credit score? No, your credit utilization, your balance divided by your limit, is a major factor. Paying down your balance improves your utilization and boosts your score. The myth that carrying a balance helps you is the single most profitable lie they tell. The problem isn't that you're in debt. The problem is that you're following a repayment plan designed by your collector. So what do you actually do with this information?
How do you escape the trap?
Let me give you something practical. Strategy number 1, the statement shredder. This is mental. You literally train yourself to ignore the minimum payment due line. To black it out in your mind, it doesn't exist. This works because it removes the psychological anchor. You stop taking repayment advice from the entity that profits from your slow repayment. Here's how to implement it. First, log into your card account. Second, find only 2 numbers, the statement balance and the current balance. Third, make one of those numbers your target, the minimum. Fourth, pay whatever painful maximum you can muster toward that number. For example, if your balance is $2,500 and the minimum is $50, you don't think 50. You look at your budget and ask, what can I throw at $2,500? Maybe it's $200. That's your payment. Strategy number 2, the interest first snipe. Behavior. This is a micro habit. You make tiny, frequent payments specifically to attack the interest before it capitalizes. This works because credit card interest often compounds daily. A small payment between statements directly reduces the principal that the next day's interest is calculated on. It's a tactical strike. How to implement. When you get paid, immediately send a $25 payment to your card. If you get a cashback reward, apply it as a statement credit instantly. Have a no-spend day? Send the $10 you saved. These aren't payments, they are interest assassinations. Over a year, this can shave months off your debt. Strategy number 3, the fixed payment anchor. You set a fixed, aggressive monthly payment and stick to it like a car loan, even as the minimum decreases. Yes, this works because it reverses the amortization schedule. Instead of tiny payments stretching forever, a fixed, larger payment front-loads principal reduction, causing the debt to collapse faster and faster. Implement this by calculating a payment that would pay off the debt in 3 years. Use any online calculator. Set that as a fixed automatic payment and never, ever reduce it, even when your statement says you can. On that $5,000 debt at 25% APR, a fixed payment of $217 pays it off in 36 months, with $2,812 in interest. You save over $10,000 compared to the minimum plan. But the biggest shift is psychological. You have to start seeing yourself as a principal destroyer instead of a minimum payer. Your metric of success is the principal balance going down, not the monthly bill getting paid. You're not a responsible debtor. You're a wealth recoverer. Here's what I want you to do this weekend. Open your latest credit card statement, get a pen, draw a huge physical X over the minimum payment due. Circle the total balance. Right next to it in big letters, this is the enemy. Then, immediately transfer $1 from your checking account to your card right now. That's your first sniper shot. What you'll discover is that the feeling of power from attacking the principal is infinitely more addictive than the hollow relief of meeting a minimum. I want to leave you with one final thought. Credit card debt isn't really about money management. It's about time theft. Every dollar of interest you pay is an hour of your future life, your labor, your creativity, your time with family that you are selling back at a massive discount to a bank. We thought credit was access to a lifestyle, but we were trading our future sovereignty for present-day convenience. Our grandparents saved for purchases, financed them instantly. We traded patience for penalty. The people who actually thrive financially aren't the ones with the best rewards points or the cleverest balance transfers. They're the ones who have rejected the time theft model entirely. They use the system, they don't feed it. You can't out-budget a mathematically rigged system, but you can outsmart it by seeing the true cost and attacking the principal with relentless, intentional fury. The power was never in their hands, because you approve every single payment. You're not broken for feeling stuck in the minimum payment cycle. You're human, responding exactly as the system designed you to. That journey is unfair because you were never taught this math. But once you understand the double dollar guarantee, you can break it. If this video reframed how you see that monthly statement, share this with one person who needs to hear it. Smash that like button and hit subscribe for more content that challenges how you think about money. Thanks for watching, and I'll see you in the next one.